Hello traders, Gary Wagner here, just about 10:15 in Honolulu, 4:15 in New York. It is Monday, May 23rd, 2016, and we are looking at a Standard & Poor's that is trading off about 0.25% on the day at 2045. It's traded to a low of 2043 and a high of 2056. Dow Jones Industrial Average, in essence, unchanged on the day, off 8 points at 17,492. But the key, traders, today, more than anything else, is volume. Volume is light. It is tepid. We haven't seen this little volume for about a year. In fact, exactly a year, almost to the day, last year, Memorial Day weekend, is when we experienced the lowest volume of the year, matching the numbers that we are seeing today. So traders, absolutely no doubt, very, very light volume, but we do have a bias to the downside. We are looking at a daily chart, standard candlestick format, Dow Jones Industrial Average. We've identified series of tops that we looked at to see if the market could reach those tops, and if so, whether they would back off as they have previously. In this particular occasion, meaning this last top that we got mid-April, that's the last time we saw the Dow over 18,000. It really has not looked back. We have seen the market go from what? 18,200 down to 17,400 on an intraday low. Of course, it's at 492, call it 500, but we have seen it trade below 17,400. So about a 1,000-point drop since last month when we consider how the Dow is doing. Now, the S&P, of course, is faring about the same. And when we look at the S&P contract, really what we want to determine on this is whether or not we are going to remain in a consolidated, very, very narrow trading range, or break as we saw with the Dow. Because unlike the Dow, when we look at recent price activity from April, yes, we hit this high at 2,100. That's right in here. And yes, there's absolutely no doubt that we've seen the market trade and track lower from 2,100, though it's at 2045. So we haven't seen the same percentage size move in the down in the S&P that we saw in the Dow. And so the other thing that we've noticed is we've got this really tight trading range between 2080 in the S&P on the high side, and that is obviously where we're pegging our current resistance at. And then on the low side, about 2040. Now, you do have the market going below that. You have some lows that are below that, but look at the real bodies, meaning the relationship from where the market opened to where the market closed, and you'll see that over this month and last month, although we've had lows that have breached 2040 on the S&Ps, on a closing basis or an opening basis, we haven't seen the market trade within that range. And it is because of that tight range that we have genuinely stayed sidelined in the market, not putting on any recent S&P trades. This chart that we're looking at, this is the dollar index closing off 0.07%. In essence, again, unchanged on the day, 95.25. And the real question is whether or not we will find some real resistance. We talked about this a little bit on Friday, is that this would be a logical point to look at for some resistance, some kind of headwinds coming into the market, indicating that we'll see the dollar move lower. Of course, a lower dollar would represent more bullish sentiment for gold, obviously, but let's see how the market reacts, because since the market's traded to 92 on the dollar index on an intraday basis, and this candle, this one day, was a phenomenal day because we saw it trade to an extreme low and an accelerated amount of buying coming into the market, really propelling the market back up. My sense is that we are looking at a potential area in which we'll see this market retrace a little bit. It could still be definitely on an upward track, just as we have a downward track here. We get a retracement and then it continues in that prevalent direction. So we could easily see that, and especially if we do get more hawkish remarks from the Fed and we get interest rates moving higher, we certainly would see that put pressure on gold and see some bullish sentiment reemerge in the dollar. Now, traders, so the one market that I am actually becoming bearish on and think we could in fact see some sort of retracement is crude oil. We're looking at a daily chart. I've just brought over a monthly chart, and the reason I want to take a look at this monthly chart is so that we can see the broad moves we've seen over the last 4 months of trading since this market traded to a intraday or intra-week low, I should say, of about $26 a barrel. Now, we're a lot closer to 50 right now than we are to 26. Crude oil today, 48.11, off 30 cents a barrel, or about a 0.62% drop. I believe that we could in fact be at these upper levels. We'll have to see more technical confirmation of that fact, but I am looking at this as a strong potential short in the market, shorting crude oil. If all of the parameters that we're looking at do in fact line up in terms of my exit strategy or goal for that, if we get some weakness coming into the market here, you really don't have any strong support on a technical basis till about $43 a barrel. That's about a $5 drop that I believe we could see per barrel in the price of crude oil, and that's based on this technical support that you have here back in September, October, and November of last year, as well as April and May lows of this year. That would be the area that I would look at. Below that is about $40, but you're not going to get the same amount of technical evidence that you're getting at the $43 level. So that's a market that we're probably going to look to make our next play in, and we will probably look to short the market. These are the price points I believe that are achievable. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.